Hi, everybody. How are you doing? I'm Mark Sebastian. I am your only option. I hope you had a great morning. For me, in the Midwest, or not the Midwest, in the Central Time Zone, I got 4 minutes left to my morning. For those of you that don't know who I am the founder and CEO of OptionPit.com. We have been around since 2010. We are old men when it comes to, and old women, well, not old women, but we've been around the block, folks. And we're talking about something very important today. And that is how the entire investing approach has changed. You know, you go back to the 1980s, the 90s, or even like the 2000s when a lot of people really got into investing, right? When we got away from pension plans and really got into 401ks. And what did they always tell you? What did they always tell you, guys? They said, yeah, have a mix of conservative investments, have your blue chip investments, and then have your small speculative portfolio. What they didn't tell you is that in 2021, every stock was going to be your speculative portfolio, except for the stocks that didn't go up at all and were reducing their dividend. They didn't tell you that bonds were going to peak out and then roll over. They didn't tell you that you were going to see huge volatility in precious metals and alternative assets. Right? Private credit was supposed to be a linchpin. That's a problem. Regular credit, junk debt, bonds as a whole. Bond market's been terrible. The investing landscape has changed. But it's changed to your benefit, folks. If you are here, you are a beneficiary of what we're going to be talking about today. Right? The S&P 500 is sitting at an all-time high. Does it feel that way? Q's, same story. Does it feel that way? We'll talk about that a little more in a second. But, one of the things I love about what we do here is the people that we touch and where they're coming from. We have people that are members of Option Pit literally on every continent. And I count Antarctica because one of our clients, I can confirm, was a scientist on Antarctica for a full year. So, I'd love to know, where are you coming from? Where are you coming from? And then 2, on a scale 1 to 10, 10 being I feel great. Right? I just won the lottery. I got a date with the person I that is on my bucket list to get a date with. The He-Man movie's premiering tonight. You name it. All right, that's 10. 1, I feel I'm terrified of the market. So 1, where are you coming from? And then 2, on a scale 1 to 10, how good do you feel about this S&P all-time high? We got Ronman saying, Nanyam saying they're coming in from London, Ontario. And they're at a 3. Clarence is in DeMott, Indiana. I'm not, is that somewhere near Indianapolis, I assume? Bill Bailey's sitting at a 5. Jose's at a 9. B. Davis in Northeast Pennsylvania. Probably near Scranton, near where I was over the weekend. He's at a 6. Leo's at an 8 in Monterey. Bob's in the Panhandle. Jay Shuck coming from Michigan. Bob G's at a 9. Finn's in Virginia. He's at a 5. Ron's in Scottsdale. Oh, near beautiful Crown Point, Indiana. All right. Salisbury, Pennsylvania, Southeast Pennsylvania. We got Houston, Lansdale. We got people from all over. And we got feelings of all over. We got people at a 9. We got people at a 3. That makes sense. There's a lot of confusion in this market. There's a lot of confusion in this market. And that is probably why we're getting so many mixed reactions. Because, you know, if you are all in NVIDIA and Apple and Amazon and Google, you're feeling great. You're feeling great. You have a very specific portfolio. But if you're one of those that's in a diversified portfolio that's paying that pays dividends, you're not feeling so hot. If you've got bond exposure, you're feeling even worse. A lot of people don't know exactly what to do in this market. We're sitting at all-time highs. We seem to be at new all-time highs all the time. Yet how many of you here are afraid that there's going to be a shoe that drops? How many of you are afraid? Type in 1 if you feel like there's an impending shoe. 2 if you don't. Or drop a shoe emoji if you think the shoe is coming. Drop a smiley face if you don't. And that's the problem. We're all so afraid of the veritable shoe dropping and wiping out our gains because we can sell off so fast. We can sell off really quickly. What's really built the run that we're in right now? What's built this run that we're in right now? Yeah, AI. And yet, the news yesterday, ChatGPT didn't hit 1 billion users a month. That was their target. And you're seeing the effects today. You have Iran that could be a shoe that would drop. Nobody looks at this 71.30 or wherever we're trading right off all-time highs and says this feels great. But you can't afford to not be in the market either, right? If you were sitting there on April 2nd and saying, this run, it's not going to last. Look what you missed. A run from 6,400 back up to 7,200. Like 12% in about 3 weeks. Investing for your retirement is different now. It is not what it used to be. It is a completely different animal. You still need that income from bonds, but you're not getting it from bonds. You still want that growth from stock, but you don't want to be married to 5 stocks. What do you do? What do you do? That's why we're here, folks, because we're going to discuss the great income reset. So let's begin. And welcome to day 1 of 3 days of this great income reset. Me and Hans are going to be here every day starting at 1 p.m. Eastern time to help you through this reset. Now, today is going to be some stage setting, but you're going to want to make sure you attend all 3 days because we're going to set the stage. Then we're going to show you how to take action. We're going to show you what you can do to take some action. We're going to show you how you can take that action on Friday. We're also going to be delivering a nice bonus trade on Thursday as well. So let's talk about the fundamental shift in the economy. My dad, God rest his soul, worked for the same company from 1970 until 2006. 36 years. Went through a couple of name changes, but his role never changed. I'm sure many of you here had a similar career. But I'm not, I got that career, right? I've been at Option Pit for 15 years, 16 years, but I had to start the company. I look at my 16-year-old and I ask him, what in the world is he going to do? It's funny. He's smarter than me. He's more athletic than I am. He's taller, better at just about everything except telling dad jokes than I am. And yet, I have no idea what his life is going to look like. Heck, if I was in my 30s, I wouldn't know either. Heck, I'm in my 40s. If I didn't have this, I look around at my other friends that work for corporate in really good jobs like at Meta and AMD and Microsoft and Tesla, General Electric. They're 45 years old and they're asking themselves, what is about to happen in my career in the next 5 years? And they don't have an answer, folks. They do not have an answer. Well, they should be here because we're going to present you with that answer. Gone are the days of the pension. And if you started with the 401k craze in the 90s into the 2000s, you're doing great. But how about if you started a 401k in the last couple of years and you started with a 60-40 portfolio? That strategy has not paid you very well. What worked for creating income and for investing 20 years ago, 10 years ago, 5 years ago, heck, 2 years ago, not going to work anymore. Your old income playbook of get a degree, get a good job, work for 30 years. Or heck, the next generation, the millennials said, get a degree, get a good job, move to a better job, move to a better job, move to a better job. That may not work. The playbook has changed. The market has shifted. The idea of passive income doesn't really exist the way we used to think it. Certainly not in something that is securitized, like bonds. And how many of us want to deal with having property managers and rent? I mean, interest rates are so high. How much are you going to charge in rent if you want to own, let's say, a 3 flat? That's even tough. That is tough right now. Does not pay you the way they pitch. So over the next 3 days, what Hans and I are going to do is reset your methodology, reset your approach, teach you how to attack this market over the next decade. And I'm excited for it. Now, before I begin, I have to remind you that Option LLC is here for informational and educational purposes only. We don't offer investment advice, legal advice, tax advice of any kind. If you see something and you do something, you take action on it, you do so at your own risk. Here's our agenda today. Well, I just told you why we're here. We're going to explain to you what is the great income reset. What is it? We're going to talk about what the gold standard for investing and why it's broken. I'm going to walk through the death of the bond market, the full timeline, and then give you some action items. But to help you and I through this journey, I'm going to be joined by Option Pit's head income trader, Hans Albrecht. I've known Hans for over a decade. He ran billions in option-based assets, generated $750 million in option-based cash flow. He specializes in income and capital preservations using calls, put sales, black swan protection, turbo trades. He is a jack of all income trades, you might say. And he's one of the smartest people that you're ever, when it comes to this market, that you can possibly get to have exposure to. So with that, let's have Hans jump on board and join us. Good morning or good afternoon, Hans. I hope you're doing great. Good to see you.
Good afternoon, Mark. I like that. Jack of all income trades. I've been called Jack something else before, but not Jack of all income trades.
No, yes. So Hans, we're at a major inflection point. I don't know if you heard me talking about it. I know you've got kids about the same age as mine, and I know your kids are smart as a whip. And, I know you've got friends that are your age or younger that are looking at their careers and saying, what am I going to do? Does a lot of what I just went through ring true for you?
It does. I mean, I don't envy young folks these days. We've seen some of the numbers, some of the sort of youth unemployment numbers, and we know people are having trouble finding things. We'll have to see how that plays out over time, right? They don't want entry-level people anymore, but then how do you groom people to move up the ladder? Unless you don't need the ladder. You don't need the ladder anymore because it'll be a robot. But look, I love how you set everything up, Mark. And I think one of the important things is for everybody to kind of, take a deep breath and realize that you haven't done anything wrong, right? Things have changed, and we're going to show you exactly how. But basically, they've pumped up assets and stocks and home prices, and we've had massive volatility because of this pumping. COVID hit, and guess what? They bailed out the rich. They left the rest of us with crushing inflation. So that's not on you guys. They've got their rules. We live by them. It's print, 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 print. And that's good for the same people making those decisions, which is kind of interesting. Funny that. It's good for all those folks. But here's the reality. The system kind of isn't built for anybody with less than $1 bazillion. Well, let's say 10 or 5 million or 3 million, whatever number you want to take. Your advisor is going to talk to you about the 4% rule, and you're going to take 4% out a year in your retirement. That sounds great. What if you've got 300 grand? That's good work, but do the math. And that's where people start to think, this may not be going in the right direction for me. That's not a retirement. That's kind of squeaking by. And then to your point, you don't get the gold watch anymore. In fact, you don't even get the gold watch. You get the boot pretty quickly. And you look at, the Metas, the Microsofts, the Amazons of the world, they're laying off thousands. Is it because they're losing money? Mark, are those guys losing money?
No, they're making money hand over fist.
Wow. These are the most profitable companies in the world, and they keep laying off people like it's going out of style, and just zero shame about it. And the AI guys are like, yeah, everyone's going to lose their jobs. That's amazing. These guys shouldn't even go on TV anymore. So I think what we want to realize is that they're interested in profits and doing well, and they don't, and you should be interested in that as well. Tim Cook's going to be fine with his 500 million. He kind of
Yeah.
sucks as a CEO, but he'll be just fine. So over the next few days, we're going to kind of debunk some of these traditional investing playbook ideas that have been working, but are now failing the average person. And then, of course, I'm going to show you the strategy that's returned about 28% since last April. Yes, the massive sell-off. And we're going to see if there's actually a better way to do things. So let's get into it.
Yeah. So I want to talk about these strategies that we contend really do not work anymore. The first one is bonds. They're supposed to be a big portion of your portfolio, and they have been awful. Owning government bonds, U.S. debt is you know, when you buy government debt, you're buying the faith and confidence in the United States. If we didn't have F-35s, how much faith and confidence would there be in the United States, Hans, and that debt that the U.S. is carrying? That faith and confidence has switched from, betting on the economy to we're the biggest military. It kind of feels that way, doesn't it, sometimes?
It does. It really feels like we're almost on a knife edge here of this sort of long-standing tradition of there is nothing other than the U.S., but it's risky.
Yeah, it is. We've got we're approaching 50 trillion in debt. And then safety assets. Now, precious metals, they have a place. I'm not saying gold bugs, don't go crazy on me. I'm not saying don't own gold. But even the gold bugs here will have to agree with me. Type in a 1 if you agree with me. Gold traditionally was an asset class, gold, silver, precious metals. They were an asset class that moved up a little bit better than inflation. It was a store of value. Look at the volatility we've seen in gold markets over the last year. Does that speak like a store of value or something that is changing? Something is trading more like crypto or a risk asset. Now, gold bugs, again, I'm not saying is gold worthless. What I'm saying is, have you noticed the change in how gold is moving and how volatile it is? Type in a 1 if you've seen it, and type in a 2 if you think I'm crazy. And then last but not least, dividend stocks. Now, there are, you will have sectors of that will take off, like take energy, right? But look at your classic high dividend names. They're really just not out there, and they're not performing, right? Is there in the 80s, everybody owned utilities like ComEd. They owned AT&T, now Verizon, Comcast, cable companies, all these names that you knew were going to have maybe not crazy growth, but would have consistent revenue, consistent growth in the dividend. Just about that entire area is being disrupted. Right? Cable. It's I laugh because I now pay we used to complain about all the about cable and that forced bundle, and now you have 10 streaming services and you're paying the same price, just $9.99 or $15.99 or $19.99 in 8 different places instead of $199 in one. But even safety stocks like dividend stocks, they're not working. There's no growth there. The dividends aren't beating inflation. All the safe havens have changed, Hans.
They have. They've jammed them up. And now, in a world of, I call it the age of ultimate disruption, you got to be really careful because you can't just think about your dividend yield. You got to think about the existential risk in some of these companies and some of these industries. Things are changing fast. If anybody's noticed what's happening to software, you really, really have to be on your toes. So add that to the pile of things that are a lot less certain as they used to be.
All right, so this brings us to the old 60-40 rule. And you could say it's, 60-30-10 if you're a big precious metal person. The idea was you had 60% in stocks like the S&P 500 and 40% in safe haven assets, mostly bonds. When the stock market was down big and bonds were up, Merrill Lynch might make a big, bold call. It's time to switch to 65-35. And when stocks were at their highs and bonds were at their lows, they might go, whoa, people, we're going to the 55-45 portfolio. Look out, Hans. Look out. Bold.
Amazing. They move. I see what they did there. They just moved the 5 around, 5%. That's very clever.
Oh, yeah. Now, you might have somebody go crazy and go 70-30 at real floors, but
that's nuts.
The point is 90% of the time, and this is still the case, right? I'm going to get a knock on my door from Primerica at some point. Now, it's great because when Primerica knocks on my door, hi there, I'm 22-year-old fresh out of college, and I'm here to help you with your portfolio. And I look at them and I go, I'm a professional trader. They go, nice meeting you. Have a great day. And they leave.
Mark, you should be more supportive of the younger generation, given what's going on out there. Come on.
But they're going to put you into cookie cutter stuff that is going to underperform the market, into assets where they're charging you, where they've got fees layered upon fees, layered upon fees. You're going to see, oh, they're only charging me 50 basis points to manage my money, but they put you into Primerica's S&P fund that charges you 1.5%. They put you into their bond fund that charges you 1.5%. Their bond fund's got a 12B1 fee on it that they don't have to, that they also have. There's another 25 basis points. Next thing you know, on a portfolio that's already going to underperform, you're underperforming that model portfolio because they're charging you fees out the yin-yang. So that 60-40 portfolio, again, it says, 60% stocks growth, 40% safety hedge. Stocks fall, bonds go up. Stocks go up, bonds fall. We had an amazing period post-financial crisis where the two worked in tandem. Folks at home that are in your 70s or 60s, 50s even, that 10-year period from 2008, 2009, if you got in there and you rode it up to 2018, that 60-40 portfolio was the best trade you could do. Yields went to zero, meaning bonds screamed higher. Stocks just went up and up and up because we had money slushing about. That portfolio has not been effective since then. In fact, it's been terrible. So here, Hans, what do you got?
There you go. Like you said, Mark, it used to be like clockwork. And I remember being on the floor in that sweaty mass of folks on the floor, and somebody would yell, "How high bonds?" And it was like you knew that stocks were going down, or they would say, how low stocks means bonds were going up. Of course, they were usually bragging about their position, but basically you knew that things would move in the opposite direction every time. It really was like clockwork. And that's not the case anymore. That just isn't the case. And so if we look at what we've seen in the last 20, 25 years, and this extends back to what Mark said in the 90s, you can see stocks have been volatile over time, and that's pretty normal. They're perhaps a little bit more volatile. We've seen some crazy V bottom moves and things like that in the last 5-10 years. That's kind of new, but we're getting more volatility. You can see with volatility, what is a constant here in this period before 2015, 2016-ish? Well, bonds are doing their thing, right? Bonds are doing their thing. Stocks are going up and down, and bonds are acting as a ballast to cushion you against that volatility. That's where your 60-40 comes in handy.
Yeah, so this is the annual returns of bonds and stocks. And, what I want to point out is the run that we saw during that period that I just talked about. Look, 2008, obviously the bottom for stocks, we get a bottom for corporate bonds. Corporate bonds had a banner 09, so did stocks. They held that up, having really nice years. 2013, a banger of a year, having really nice returns all the way through 2015, 2016, 2017. Look at this. Stock price is volatile. Bond prices, nice and stable. You get a couple of really nice years, but for the most part, they do great.
And that's what they're supposed to do. Now, let's move over. And everyone, do you notice something different on this next slide here? Something different is happening here. If we zoom in a little bit, I think we've got a little zoom in here as well. We can see that things are starting to move together to the right side of that chart. Look at them sell off. We can see that 2022, we're going to talk about that in a moment. Things are looking a little bit different. They're correlated. What does correlation mean, guys? Well, for anybody who hasn't heard that term, things either going together or things sort of dispersing, like going in different directions. They're highly correlated. And that's what you don't want in a 60-40 portfolio. You want that ballast. You want that sort of anchor sitting there. And so really the bottom line is that it's not that you're doing anything wrong. It's that a lot of people are still running strategies that kind of were built for a world that no longer exists. And there are many, many reasons for that. The stimulus, all this other stuff that Mark's been alluding to. It's just things are just different now.
They are. I mean, you look at you've got the stock market moving up and down, but now you've got the bond market moving up and down as well. They're basically, bonds are turning into just a worse performing version of the same thing. You own a corporate bond, might as well own the stock, because the only thing you're going to do is get penalized just as much on the downside and not participate on the upside in the same manner. It's a loser's game. I mean,
correlation, folks. Correlation, right? Sound familiar? What do you think Bitcoin's done? Remember when Bitcoin was kind of this like, oh, it's the new gold, it's a store of wealth, it's a place of safety. Similar sort of thing. Suddenly everybody gets on board. BlackRock's a big buyer. Everybody's buying it. And guess what? It starts to look like levered NASDAQ. It looks like the NASDAQ, leveraged version of it.
Absolutely. And, this is why we're telling you that 60-40 portfolio is dead. You own corporate bonds? Why? Own the stock. Corporate bonds are going to return less in good years and perform just as poorly in bad years. That's never been the case. So here we are now. We're looking at a time that should be very familiar to you. This was when we had the tariff tantrum last April. And you can see how poorly the S&P 500 did. Right? Trump announces sweeping new tariffs. the market tanks. But now, take a look at the bond market. Stock market down, bond market down. This was within the last, just outside of 1 year ago, folks. And the worst part is, look at this nice recovery the stock market made. Right at its lows, it was down 14%. By the end of this period, it's down 9%. Bonds never recover. They still just sit there and stink.
Well, think about just recent times in March. They got crushed. Bonds got crushed again. No safety there.
None. Not in corporates, not in government, not in junk debt, and certainly not in private credit. But Hans, people do need that income. They do need that safety. They do want that part of their portfolio that's more stable. Everybody wants that. You want that and I want that, don't you?
I do. And that's what we're here to do today, right? We're here to show you why these traditional methods aren't working. And we're going to talk about Mr. Briefcase next, I think.
Yes.
Mark. Mr. Briefcase, there he is.
So we want to take you through how bonds died. And it starts in 1987. Paul Volcker retires as chairman of the Federal Reserve, and in comes Alan Greenspan. He begins his tenure as Fed chair. He stays as Fed chair for nearly 20 years. In 2001, and Hans, I remember this day. In 2001, and this is before 9/11, I've just been hired by Group 1. I'm doing my official office visit for acclimation. So this is like April 2001. And I'm sitting up, they're showing me the floor. And in the middle of the day, Ben Bernanke and the Fed Alan Greenspan and the Fed surprise cut interest rates by 50 basis points. Market goes wild. Then we get, market goes wild. People are okay. Then we get 9/11. And they continue to cut and cut and cut. By the time we get to the financial crisis, interest rates drop. The Fed funds rate drops from 6.5% to 1.75%. Folks that think that the Fed funds rate at 3.5% is high, I'd remind you in 2001, it was up to 6.5% before he got started. Then we get the 2008 financial crisis, and then we get 2022. So yeah, he's Fed chair from 87 to 01. And he lowered interest rate to combat market crises. Black Monday. This is what he did. All he knew how to do was cut rates. Seriously.
I remember everyone would watch. He'd be walking around with that briefcase, and they would wonder. It was like in Trading Places, the orange juice futures, the crop report. It's like, oh my God, is he walking differently? Did he turn left instead of right? Could that mean something? Is he cutting rates? Or it was always fun. This is the kind of fun we had before there was all this current entertainment, guys.
But he stepped in after the crash of 87, dropped rates by 80 basis points, 0.8%, which is a huge drop for interest rates, and then slowly raised them back in 1988. The precedent was set, though. The Fed would intervene when the market faced a downturn. 2001, economy due to dot-com bubble bursting, 9/11 crushes rates. I remember this happening. He was the put. We called it the Greenspan put first. I mean, look at the run that Treasuries had in 2001. The return on owning a bond exploded, but the yield, what you're getting paid, not so much. And now our old friend, Ben Bernanke. Miss this guy, don't you?
You know what? Greenspan came in right before the crash. Ben Bernanke comes in not too far before the big event, the financial crisis. Huh.
Yeah, no, Greenspan saw the writing on the wall and got the heck out of Dodge. That is the truth. His focus was on transparency and inflation targeting rather than bailing out the market, or so he said.
Yeah, he bailed it out anyway.
And then he bailed it out anyway.
He had no
and
choice.
You under Ben Bernanke, as the 2008 financial crisis, treasuries exploded. 2-year bond exploded. Treasuries were the safe haven asset. And that's one, because people were scared, and two, because Bernanke was absolutely crushing rates and introducing new concept that we'd never seen. Quantitative easing. Operation Twist. Things, unprecedented steps that became what is now known as the Bernanke put. Heck, the Fed is still sitting on a portfolio into the trillions of U.S. debt. Rates got to near zero and stayed there for a very long time.
They did their job, right? Bond prices went up, 10-year spike. I mean, that's good for a 60-40 portfolio. Except the problem is you can't get much lower than zero, right? When you're running ZIRP, it's like zero interest rates. Okay, what can we do? So that's why they had to get fancy, right? The government has special rules. They can print, they can do whatever the heck they want. And so they have to invent new tools. They're very good at inventing things or resurfacing them. And that's part of what makes it difficult for bonds to do what they're supposed to do.
Yes. And, you know, it was an unprecedented time. All right, now we hit 2022. And Powell, now chairman of the Fed, gets dealt kind of a tough hand. COVID, AI, inflation. They raised rates from 0.25% to 4.5% in 2022. S&P 500 ended the year down 15%. And guess what? Bonds failed to show any gains because we were raising rates. Look at this. In 2022, we saw the 10-year Treasury take it on the chin. We saw the 2-year Treasury take it on the chin. And we saw the S&P 500 take it on the chin. The 60-40 portfolio, I mean, Hans, it got wrecked. Worst
year for the 60-40 at that point since 1937. I remember that was there were a lot of headlines talking about that. What happened to the 60-40? Not good stuff.
And not good stuff. And this is what we mean. 60-40 is dead. Is there opportunities for strategic bond trading and buying? Yes. Yes, there is. But the idea that you should buy and hold U.S. Treasuries for years and years and years. Does that make sense to you, Hans?
No.
No, it doesn't.
The stability is gone, right? It's the correlation is quite incredible when you look across the board, and that's endemic of a kind of very similar trajectory for everything, just kind of juicing and stimulus and all that stuff that's contributing to high volatility. But guess what? Traders can take advantage of that. Traders can take advantage of that.
Yes. So bonds were negatively correlated with the stock market. They provided stability during downturns. Take a look at this last downturn, folks. Did bonds, even government bonds, provide you any stability? They didn't provide me any. So as interest rates would drop, bond prices steadily would increase because that was what happening in the sell-off, not in the market we're in, and not for the time being. Interest rates are too low for bonds to remain as stable with the inflationary environment that we're in. Hans, and you said this, the 60-40 portfolio has lost its ability to be stable.
This is what we kind of backed ourselves into a corner here, right? This lowering rates to bail out the market, to never allow price discovery to truly work its way through the economy, through the rate environment. This is it. This is why bonds are very correlated to stocks. It's not some sort of weird fluke. We've kind of created this environment. The people in charge have created this environment. And that lack of stability is something that we really have to be aware of now, that the textbook has changed. And if we're doing the same thing over and over again, that isn't working, you can expect more of that over the next few years.
You can. Now, I don't want to, Hans and I do not want to sound like negative Nancy's. We're not. We wouldn't be telling you this if we didn't know that there was opportunity out there. And there wasn't the opportunity to create income for your portfolio that wasn't bond-based. So what we wanted to do was really open your eyes to and invite you to take the opportunity of what is in your portfolio and give it a hard look. If you've got a financial advisor, ask them these hard questions that Hans and I have been asking you. So let's look real briefly. We're going to dig into this a lot more, but let's take a look at Hans's solution. And this is Hans's portfolio growth versus the 60-40 benchmark, October to March. So the last 2 quarters. And I think the proof is in the pudding. If you invested in a 60-40 portfolio starting on October 1st through March 31st, you've made 2.1%. If you did that, if you traded with Hans and used his income strategies, you'd be up 14.4%. You'd be crushing it. Heck, you'd be outperforming the S&P on its own. Hans, you returned 7 times more than the 60-40 portfolio in the last 6 months. And every month you returned at least double. That's pretty impressive.
Well, look, I mean, experience helps, right? I don't buy and hold and hope. I'm strategic. I'm strategically greedy at times. Sometimes I'm going to play for a little bit of high vol, sort of high premiums, right? We want to take advantage of those things. That's where income trading can really, really kick in nicely. Is, Mark, you remember the last decade? I mean, it was like a lot of paint dry watching kind of stuff. It was very, very, you really weren't getting paid for any kind of risk, upside risk, downside risk, you name it. We really have had a return to being compensated for movement and volatility. And that really plays into the strategy. So over the next few days, I'm going to reveal that strategy, exactly what I do. And it's not complicated. It takes a little bit of work, a little bit of preparation. It takes a little bit of experience, right? My 30 years of learning the art and science of trading is tough to replicate, but I have a hack for that, which I'm going to tell you about. And so tomorrow, I think it'll be exciting. We're going to keep debunking. And of course, we're going to talk about what the right strategy is going forward. And that really is going to separate the people who are squeaking by. Remember my 4% example, who are squeaking by on that 4% from the ones that are building real income, building that real future, separating yourself from the folks who are going to kick back and decide that, well, I'd rather watch, season 3 of what is it, the Golden Lotus or the White Lotus, instead of looking into my future. And there has never been a more important time to take that financial future and take a really, really good look at it. And I'm going to be giving away a stock that I think is doing all the right things in the right places. And I think that's very important. Mark, you know that these days you have to be not just in the right race, you got to be on the right horse within that race. And I think that's going to continue to be the case in the ultimate ages of disruption. So I'm looking forward to tomorrow.
Me as well. We presented kind of what the real problem is with the market today, Hans, you have. And tomorrow we're going to talk a little bit more about those problems, but then we're going to start offering solutions, right? Option Pit, myself, Hans, we're a solutions-based group, right? We don't sit around and complain. When we see a problem, we attack it. We lead. Hans, you pointed out this problem for some time. That's part of why you built Turbo Income within Option Pit, was to address the problems of the 60-40 portfolio and the needs of everyday investors and people that want to grow their portfolios. So yes, today we were explaining what's broken. Tomorrow we're going to talk a little bit more about what's broken, but then we're going to start shifting into how to fix it. And that's the exciting part that we're going to be that I can't wait to dig into on Wednesday and into Thursday. And Hans, I'm looking forward to your safe haven stock from your portfolio and that bonus trade that we're going to talk about on Thursday. So folks, make sure you join Hans and myself tomorrow for day 2, same time, same place. Do we have any questions for Hans before I cut him loose? A lot of people telling old-timey stories about where they were in 87. Hans, always fun. The list of stocks, when do we get it? Great question. That the team will answer that one in chat. Just received my notice for COLA of my New York State pension, goes up 3.5% tomorrow. And Northport Florida man brings up exactly what is killing New York, right? He's getting a 3.5. He's getting a pension. He lives in Florida, and his pension is being paid by the state of New York because he worked and lived in New York up until he retired. Portfolio size for the strategy. Hans, this is designed for anybody, right?
It is. Yeah, it is. It's really great. It's versatile in that you can adjust the legs in the strategy to conform to whatever portfolio size you have. So it really is, for the most part, for most of the kinds of trades that we do, very, very versatile. So yeah, absolutely. So for, 5, 10,000. I mean, it doesn't have to be a $50,000 portfolio.
Yeah, start with what you have and build it. That is, and build it smart. We're going to talk more about holding times and stuff like that tomorrow, CC. So make sure you join us. What do you think of high yield bonds?
I think high yield is probably high for a reason. I'd be
Yeah.
Yeah.
Well, and I think that goes back to this slide, Hans, where we were looking at corporates. They're not giving you the protection that you want. And, it's not a great way to, I don't personally think it's a great way to invest. Like, I'd rather play in the stock, because the debt holders are going to get wiped out anyway on this high yield, because there's always, you always got to read the fine print on debt, because even those high yield bonds, there's always some sort of rider where somebody else is getting paid out first, and you end up with 10 cents on the dollar. Other questions? What do you think? We'll get into some of those as we move along. Got some good stories. Any specific questions to what we discussed today? All right. Yeah, the default rate of junk bonds is low. Oh, they want my I'll drop that in Delta Strike, Elio 9. All right, everybody. Hans, thank you for your time.
Thanks, everyone.
And I can't wait for you to lead us through how to transform our portfolios over the next 2 days. So make sure you're here tomorrow at 2 p.m. Eastern time. Hans and I will be back, and looking forward to hearing some of the solutions-based approaches that you have, Hans. Closing CLN says, lifetime member of Turbo, Hans does a great job. And I would agree with that. And I think that's a great comment to close on.
Thank you, CLN.
All right. So for Hans Albrecht, I am Mark Sebastian. I am your only option. We'll see you tomorrow at 2 p.m. Have a great day, everybody.
Take care, everyone.